Welcome to the Florida Real Estate and Entrepreneur Podcast, where we interview the best and the brightest business and real estate leaders. Our mission is to inspire and help 1,000 entrepreneurs to start and succeed in real estate and entrepreneurship. We will give you the exact playbook to succeed in your business through the experience of those who blaze the path. We're bringing the what's working today directly to you. Let's get started. Welcome back to the Florida Real Estate and Entrepreneur Podcast. My guest today, none other than the great John Robbart with Renovo Lending. John has an extensive background in lending funds to investors through the company he's a part of, Renovo. Guy's done a bunch of deals, knows a ton about the market. So I'm really excited about talking to him today about hard money, how it works, what are the products out there, and what he's seeing with his clients. So John, welcome to the show, man.
Hey, Adam. Thanks so much for having me.
Yeah, awesome. Hey, so let's just start, what have you done? Have you always been in real estate? How did you get to the point you are today? Like, what's your kind of story in, say 2 or 3 minutes or less?
Sure. So I was working at a nightclub in San Diego called Omnia. For those of you who've been to Las Vegas, you've heard of Omnia nightclub, I imagine. I was a bartender there, and one of my friends at the nightclub, a guy named Paul, had a client who was working in private lending and got him a job. And Paul would always tell me how he was killing it, and I was like, well, I want to kill it. I don't want to pour drinks for the rest of my life. So eventually an opportunity opened up for him to bring me on. And I started out just making cold calls and handing off leads, which for anyone who's ever been in sales, you don't generally want to do that. You kind of want to run with it yourself. But after a couple of months, they had moved some things around, got rid of some people, and brought me into an originator role. So that was, I started in August of 2019. And in February, I'm from Boston originally. I moved back to Boston. Paul had opened up his own office, so I was going to go work under him. This was like February, March 2020. I think many of you can guess what happens next. COVID, the company that I worked for, eventually ended up closing their doors. They had a lot of different things that were happening in the market that made lending not as easy of a thing to do. So pivoted. Paul and I were selling COVID masks, which is kind of funny looking back because I was about as anti-mask as you could get, but tried to be entrepreneurial. Eventually lending came back in a thing. I started up a company to broker loans, which I was doing under Paul's mentorship. While that was happening, Paul also received an offer from Renovo to be one of the first guys to work at Renovo outside of Chicago. Previously, Renovo was a Chicago-based company. They really only lent in greater Illinois, some deals in Indiana, et cetera. But he was kind of the second, I should say. The first was a guy in Texas, but the second guy to open up a market outside of Chicago. So originally he was like, hey, I'll get you in, as soon as I get my feet under me. But I was so happy running my own business that I wasn't in a rush to do it. Fast forward a bit, end of 2021, I closed maybe 38 million for the year. The following February, he did like 38 million in a month. And at that point, I knew I was doing something wrong. And I was like, I should really consider what these people at Renovo have done and find a way to maybe make it work. So I'm
going to ask you this is going to be hard questions about hard money. Okay. This is hard money. So I got to ask you hard questions. I want to talk about real stuff.
Sure.
So if somebody out there was thinking about maybe I should be a hard money lender, how much money does a hard money lender, because they always talk in terms of deal, like volume close, the loans were worth 38 million. Yeah. If a hard money lender does $38 million in loans, how much money do they make?
Sure. So at the time I was brokering the loan. So the structure that I was using was I was basically making like a 1% broker fee. And in most cases, it was anywhere between 50 basis points to 0.5% and 1%. So, that's basically, call it $350,000 in revenue in a calendar year. Now, if you have your own money, right, and you're collecting the full spread, then that number is totally different.
Yeah. So, okay. 38 million basically equates to 380,000 at 1%.
Right.
So generally there's a spread. Obviously, sometimes it's 50, 0.75, 1. I got that part. Okay. So if somebody was like, oh, I can get into hard money lending and broker loans, make somewhere between 0.5 and 1 on them. That's pretty good. I mean, 350 grand a year for somebody is a good chunk of money. It's not a little bit of money.
Totally.
Okay, so when you say if you have your own money, what do you mean by that? And do you have your own money with Renovo because you're lending their money? Is that what you mean?
Great question. When I mean if you have your own money, let's say you're Maybe later in your life, you've built up some serious wealth and you elect to lend out your own money. Let's say you have $1 million in cash or $500,000 in cash and you want to make your own loans and you're charging 12%, 2 points, which is pretty standard for a true private lender. You can make your own rules. It's your money. And yeah, you can collect all of that interest that you would make on that loan.
Right. Okay. Yeah, that makes sense. So would you say in general, whether a hard money lender is brokering from multiple different kind of funds or hard money people, or they're working specifically for a company like you guys, like they're generally making between, 50 basis points and one?
Mm-hmm.
Okay, that's good. That's like a good rule of thumb for folks if they're thinking about like, man, maybe I should be doing hard money. Maybe I should go work for Johnny.
Yeah, maybe. And there's a variety of places that you can do this, right? So obviously, if you're doing deals anywhere in the state of Florida, like absolutely get in touch with me if you have a deal that you think makes sense. With that being said, there are other companies that are also great, and if you're really inclined to be good at networking, you can get out and network with some high net worth individuals, and maybe they'll have an appetite to do some deals that companies like Renovo might not be interested in doing. So
yeah, and we're going to get into that too, because I think that is an important piece of this, because there are a lot of, believe it or not, I think one of the limiting beliefs as a real estate investor is I don't have the money, I can't do real estate deals. I think you and I both know there's like $9 trillion in the economy. There's only like a few good real estate deals, comparatively speaking. So
sure,
there's tons of money out there. Money is never the problem. Getting good deals that make sense is really where you win. Honestly, if you get a good deal that makes sense, you call Johnny. Johnny would be happy to do that deal.
Right.
Okay, cool. So how many real estate investor deals have you done ballpark as a lender?
Career or at Renovo?
Yeah, career, just like all time, just kind of ballpark.
Like the number of loans?
Yeah.
I don't know, 500.
Okay, so that's good perspective, right? Because if you think about an investor who's going to use a hard money lender, maybe they're like really good and they're doing 10, 20 deals a year. You're doing way more. You're seeing way more variety, way more good deals, bad deals. And for the 500 you probably underwrote and looked at a couple thousand.
Right.
Right.
Yeah, some that didn't go full cycle. Sure. Yeah.
Okay. So what do you see from the most successful investors where they do a deal with you? It makes sense. You see that they make money on the back end as compared to maybe some of those people who are struggling in the real estate investor world.
Yeah. I mean, I think the best way to answer that is just to kind of talk about how some of the people that do the best tend to have a niche and understand what they're really good at. And that those people that understand what they're really good at, they stick to that. And they recognize, hey, I'm really good at this. So I'm going to keep doing this. And they really hone in and specialize. And the people that think they can be good at everything, those are the people that tend to not be as good at executing. The term we use in the industry is they're not as good of operators. Being a good operator is like, hey, I know exactly what I'm doing. I know how to get in and out of these kinds of deals because I've done it before. It tends to be higher success rate, and those tend to be the people that make more money.
Yeah, the rich. They say the riches are in the niches, and
I love that.
the real power of that though is the word focus. Like these folks are focused on a thing, which allows them to become an actual expert at it. Mm-hmm. Right? Maybe it's some examples of this might be somebody who's buying first-time home buyer, medium price point houses, who does a standard, 50, 60K rehab on all of them, uses the same products every time, knows their scope of work like to a T, and they just run the same play over and over. That's somebody who can see the market, understand the values, understand the scope of work, and run that play over and over. Or that's somebody like our friend Ryan Whitefield, if you know Ryan, who's been on the show.
I do know Ryan.
Yeah, great investor in general. Ryan's does only 10 or 15, but he does high end. He pops the top off of them, bigger rehab. He knows how he can get big value on them, but he's niched down and he's super profitable in his business because of that.
Ryan originally was doing more volume. He's the one who has a son that's flipping houses, right?
That's right.
Teenager.
Kids, they're going to have a show out in March called Kids Who Flip. It's going to be on Warner Brothers. Really, really awesome. My partner, Bill, is the host of the show. It's pretty cool.
Oh, awesome. Can't wait to see that.
Yep, that's Ryan.
Yeah, I spoke with him a couple of times, and I remember him saying that one time he was doing more volume, but to your point, yeah, it sounds like the business has kind of pivoted a bit.
Yep. He was a 50, 60, 70 flip a year guy. And to your point, though, I think the overarching point here is we talk about the riches being in the niches, and you saying, like, I've seen all these people do loans and real estate investor deals. So ones who are really focused and niche down on the thing that they're really good at are the ones who win consistently.
Right.
Which just think about those words: consistency, focus, niche. You're just doing the same boring thing over and over, repeatable over long periods of time, and then you win.
Right.
Yeah. I think there's a ton of value in that. That's awesome. Okay. Let's talk about hard money loans. I hear the term private money. I hear the term hard money. What is a hard money loan?
Yeah, so I think there's a lot of misconceptions or different ways to say things in real estate. I think sometimes people who talk about hard money kind of have the connotation that it's the highest price always, and hard money, private money. Me personally, I kind of use those terms interchangeably. I was explaining this on James Lascara's video that I did with him recently, where there's kind of a spectrum, right? You've got one end of the spectrum is the bank, right? So think like Bank OZK, they tend to be pretty investor friendly. Then the other end of the spectrum, there's a private lender, and their model is, hey, we are okay with these types of properties in these neighborhoods, and we actually don't care about the credit worthiness of the borrower. All we care about is what is the asset and do we like it? And as long as the guy who's signing for the loan has a pulse, we're okay. And then there's this nice like middle ground, right? Where there's some things that the banks require, right? Like bank statements and IDs, and they run credit and background check. They also care about like the deal and like, does the deal make sense? Like, is there profit in here? There's a person who's signing for this loan. They're going to make money. And that to me is the middle ground. And that's exactly where we at Renovo live.
Yeah, I like that. And maybe we can get a little technical here.
Sure.
So the banks, right? The banks, you would go to a bank if you were a home buyer, retail home buyer. I would go out and I would get a conventional loan that's backed by the government, or I would go out and get a FHA loan backed by the government or a VA loan. Like this is kind of standard thing that most people know about. What's interesting though is when people write those loans, where I think the difference is who buys them and what are they underwritten on from a numbers perspective, right? So the government will buy up those loans, or had been historically. Right. And they're backed kind of by the government, which makes it different than for hard money loans. You guys have this whole different back end and bond swaps and all this other stuff. So I don't know if you're super savvy on all that, but I'd love to just kind of hear why it's different and why it gives you guys the flexibility it gives you.
Yeah. So first of all, thanks for touching on the fact that there's a big difference between the banks and private lenders in the sense that one has a consumer purpose and the other has a business purpose. So we only write business purpose loans. We only make loans to LLCs and corporations. To your point, yes, the government is not buying our loans. And there's a variety of ways that hard money lending companies can be set up. I think traditionally the most common was, there's a few wealthy individuals that pulled their money together, lent it out, collected the money, and the amount of money they had was the way that was the total amount to lend out. And when they were out of money, they were out of money. I think a more common, newer way, and there's a variety of ways that this can happen, is, lenders will lever up cash to get a warehouse line of credit. That warehouse line of credit, they'll put loans on the line, and then they'll sell those loans to a loan buyer on the back end, which can result in sometimes kind of a clunky experience because the people that they're selling those loans to have certain requirements. Some of them are, hey, you got to use this servicing company or one of these 3 servicing companies. You got to use one of these 3 draw inspection companies. So Renovo identified that was a problem in the marketplace because people are having a bad experience. They don't want to keep coming back to you, right? It's just like your favorite restaurant. You like going where you feel good. And we're in the business of making sure people feel good. So Renovo has their own servicing company, which is totally unique in the private lending space. We're one of, I don't know, maybe a couple other lenders out there that actually service their own loans. We also do our own asset management in-house. So when we do a draw, it's our guy that goes out, and that guy is the decision maker. Versus a third-party company, the guy takes the photo, he puts it onto his manager, the manager sends it to the loan buyer. The loan buyer looks at it, they sleep on it for a few days, and eventually get your money. It's like a totally different process where on one end, you're getting the money within 24 to 48 hours. The other one, you're getting the money in 1 to 2 weeks. If you're running a project, let's say you're running 5 projects or 15 projects, you get 75 a year you're doing, getting the money in a timely manner is sometimes crucial.
So what Johnny's talking about here is the draw process as part of that. So there's a couple things from a mechanics perspective. So fix and flip or buy and hold / BRRRR, buy, rehab, rent, refinance investors will often use hard money lenders. Hard money lenders are almost synonymous with being a cash buyer. It makes you be a cash buyer. Why? Because you don't have the same, like if I go get a loan to buy a conventional house, like person to bank rather than business to business, it typically takes 30 to 45 days to get that thing over the finish line. If I go get a loan from Johnny, he can close that thing in 7 days sometimes, like pretty quickly. Generally speaking, a hard money lender can close pretty quick. Sometimes it's 7 days, sometimes it's 3 weeks, but it's faster, way faster, right? And it's my LLC borrowing money from Renovo, and Renovo's going to lend me some part of the purchase price of this house that needs to be fixed up. Call it
80 to 90.
Yeah, 80 to 90%, which is pretty typical. And then they're going to lend me 100% of the rehab up to a certain percentage of the ARV or the loan to value. Like what will the value be worth once it's fixed up? I think it's not that complicated, but the hard money lenders will give you a large portion of the purchase price and all of the rehab money typically, so long as you're a good investor and it's under, at least 75% of the after repair value or loan to value, as they call it.
Yeah.
ARLTV. So it's important to kind of understand those three mechanisms: the purchase price, the rehab, and the after repair, or ARLTV, if I'm getting those terms correctly, right?
LTARV, loan to after repair value.
LTARV, yeah. So basically what the house is worth once it's fixed up.
Correct.
Okay. Because I think even savvy investors get this confused. They'll say like, hey, like they wouldn't fund my 90% of my purchase price. And I go, well, what was the ARV on it? And how much was the rehab? And I go, okay, you have to be all in under 75% LTV to de-risk that deal.
Right.
They're business people. Nobody's carrying that risk. That's smart, right? Okay. So hard money, Johnny, like I come to you, I get 90% of the purchase price. I get the full rehab money. Talk to me about the rehab money though, because I think if I've never done a deal before, you don't just give me that cash. How does that mechanism work?
Yeah. And apologize if I was jumping ahead with the draws. I kind of made some assumptions about maybe who some of the listeners were. But to your point, Adam, the way that it works is you get the purchase money sent to title, right? And then the difference is brought to you, and that's typically referred to as the down payment or your equity contribution. The rehab funds are dispersed as work is completed. So to your point earlier, you got a $50,000 to $60,000 rehab. Let's call it 50. You get through some of the project, right? So maybe the first things you're doing are demo and clean out, and maybe then you're getting into doing paint and those sorts of things. And then those items are on a draw schedule or a scope of work or rehab budget. Again, there's multiple ways to say the same thing in this business. All of them mean basically the same thing. But you would annotate which of those things are completed before you request a draw. So you'd say demo is 100% complete. Paint is 75% complete. And flooring or electrical, I'm just making this up, electrical is 50% complete. And those would equate to dollar amounts in a draw. So when you go to request your draw, the inspector will come out and they'll look at what you're requesting based on what you're saying is complete. And if those two things are in alignment, then you'll get sent that money within 24 to 48 hours.
Yep. So that's like, say your rehab budget is 60 grand. That money's sitting in escrow. So you're in week one of the project. You do the clean out and demo, call that a couple $1,000. Typical project. Johnny's saying this in an order because these things happen in a pretty typical order. Once you do the clean out and demo, you get it down to where it's clean and you're getting ready to start the rehab. You typically will do any drywall work, like adding drywall, putting new drywall up, or just skimming drywall, and then you'll paint a house. Like that is almost to a T how every flip will start. Obviously, if you're moving walls or doing electrical or doing things behind the walls, that'll happen in there as well. And say that's like 10 grand of the 50 grand. So before I go in, when I go into this deal and get this loan for Johnny, I'm going to tell Johnny, I'm going to use his format. He's going to tell me how he wants to see it typically. And I'm going to say, okay, here are the 5 milestones. And here's the work I expect to complete throughout it. And so now I've got 5 draws. And the draw is like, after a week, I'm going to have this much work done. I'm going to then tell Johnny, hey, on Friday, so we start Monday. On Friday, hey, the work is done. He's going to send a guy out, or there's like a virtual option for some people. Yep, but bottom line is we're going to confirm the work is complete. So if it's a percentage, they're going to be like, okay, yeah, that's about 60% complete. And then they're going to release those funds to you, which will take a couple days to get you. This is really, really important if you're a fix and flipper, because you have contractors that need to be paid. And honestly, like these guys typically want to be paid on a weekly basis.
Yep.
So that they can pay their bills and keep working. So you need to really know what the flash to bang, what the timeline is from the time I say, hey, the work's complete, Johnny, to the time I get that money if I need that money to pay the contractor. Now, Johnny, let me ask you another question, because I love this where I can bring the investor side and you can bring I can make it real for especially the newer investors, and you can kind of talk the mechanics from your side and why we are the way we are. So you're going to, let's say you look at me, you go, hey, Adam's experienced. I'll do 90% loan to cost, meaning if you're purchasing it for $100K, I'm going to give you $90,000 on the purchase price. Then I'm going to give you, say, yep.
I don't mean to interrupt. I want to stop you real quick because there's a different differentiation in terms there, and I want to make clear what some of these things mean.
Please do.
So Adam, in the example you were giving, you were saying 90% loan to cost. Now there's loan to cost, loan to total cost, and there's 90% initial loan to cost. And without getting into too many semantics, loan to total cost, right? Total cost is just purchase plus rehab together, right? So in a scenario where you got $200,000 purchase and $50,000 rehab, if you're finding those deals wherever you are, that's $225, right? 90% of $250, that's the total cost is $225. Now, if you said, hey, I'm buying it for $200 and I'm getting 90% initial loan to cost or 90% of the purchase price, that's $180. So those are two different things that mean different things. And sometimes in marketing, people will mix those terms together.
That's great. I love that. Thanks for, I think those terms are important too to understand, because it's almost two different languages. Like if I'm an investor, I just speak in purchase price. Hey, Johnny, my purchase price is $100K. You're like, cool, dude, I'll give you $90K for it. Mm-hmm. Right. And on the back end, you guys have initial loan to cost, which is basically purchase price, and then total loan to cost, which is purchase price plus rehab.
Right.
Important to understand those. So when you see term sheets, you get what they're telling you and what they're giving you. Because I see this happen where hard money lender will give an investor a term sheet. They won't completely understand it. They'll go to close and it'll be different than their expectation. Usually that's because they don't have a good guy like you who's like walking them through it to understand it. Yep. But I've seen people get mad at closing, like, they said they were giving me this much, but they're only giving me this much. So the terms are important.
Yeah, it's important to understand what you're getting into. And, I think the easiest way to just ask is say, hey, you said you do 90. Is that 90 total loan to cost, or is that 90 initial, or 90% of the purchase price? Another way of saying it.
That's a great nugget. So I want to kind of walk through. I got another question on this because this is a typical thing that happens. So if let's say I've done one flip, I used all my money and my own money, and now I'm ready to start scaling up. So I'm going to come to a guy like you to get money so that I can do more deals. Maybe I want to do 2 or 3 simultaneously. Let's say that I get the $100,000 purchase price, $50K rehab to keep the number simple. Let's say you give me 90% of initial loan to cost. So of the purchase price, you're giving me 90 grand.
Yep.
I still have to fund $10,000 of the rest of the purchase price plus the closing costs.
Correct.
Okay. So the closing costs are all the things that happen at title. So that's your settlement fee, your owner's title policy, that's your lender's title policy as well, because you are paying for a lender's title policy. So that your lender is protected, whether they're hard money, private money, doesn't matter. You should still be doing that. It's prudent. Plus all the other typical fees on the title statement. So that could be, insurance. I don't know, call it $2,000 to $3,000, right? Yeah. Insurance, which gets funded for the year.
Right.
Up front.
Your lender's probably going to charge an origination fee.
Yep. Okay. So let's say, this is good. So now I've got the down payment, which is $10,000. That's pretty clean and easy to understand. Purchase price is $100. You're giving me 90. I need 10 grand. I got about $3,000 that's got to go to title for closing. Then there are the way the loans for hard money go is like, you're going to give me an annualized percentage plus some points typically. So a point is just a percent. Yeah. So if I get a $100,000 loan for you and you're charging me 2 points, that's $2,000.
Right.
And you pay those at closing, right?
That's correct.
Okay. So now if I pay $10,000 down payment, $3,000 to title, and you charge me 2 points, I'm also bringing another $2,000. So now I'm $15,000 into the loan. Typically, hard money lenders also have administrative type fees too. Can you talk about those?
Yeah. And this is different with everyone. And not to overcomplicate the math here, but in the example you gave, it was 10% down on the purchase of a $100,000 house, but there was a $50,000 rehab. So your total loan amount is 90 plus 50, which is 140. So the 1 to 2% origination fee isn't on the purchase price. It's on the total loan amount. So not to overcomplicate the example, but I think it's important to know these things, because some people assume, my purchase price is this, therefore the points are this. It's not how it works. Processing fees and administrative fees or junk fees vary from lender to lender. I think you're probably looking at anywhere from $1,000 to $2,000. And then, beyond that, you might have to pay for an appraisal up front. There's insurance, which, I would recommend getting a quote from an insurance carrier as you're underwriting the deal. Here in Florida, where Adam and I are, it's pretty costly to get insurance. I see policies anywhere from $2,500 to $10,000 on single family properties. Multifamily is far higher. So those are things that you'd want to factor in. And then, the title company, and some of these things are not even the title company. There's, a lot of doc stamps and recording fees that are specific to the state that you live in. So there's a lot of, 100 here, 200 here, 1,000 there, 500 here. It's like all that stuff adds up, and it's important to make sure you're clear on those numbers before going into a deal.
Yeah. So this is, and this could be overwhelming if you haven't used a hard money lender or even a private money lender, even if it's just a person and it's simple, there are fees. So the beauty of this though is, I think people get frustrated with this. They're like, oh my gosh, like I didn't know this and this came up and now I need this money. Yeah. And the truth of the matter is, if you're using a hard money lender, it's often like guardrails for you, because they're usually not going to let you get into a bad deal. If it's a bad deal, they're not going to lend on it, or it's going to be so unfavorable that you won't do the deal.
Yeah, I mean, there's two ways of looking at it, right? They might not lend on it, or the equity contribution might be so high that it might not be an efficient use of cash.
Right. So if a hard money lender says they'll do, 80 to 90% of the purchase price, basically, and they'll do the rehab, but they underwrite the deal and they come back and say, really on that same $140,000 loan, the $100K purchase where they're giving you 90 and the $50K rehab, they go, I'll give you $60K on the purchase and you got to bring 20, 30, 40K. It's probably a bad deal. Like you probably should renegotiate that deal to be better. Right. So I actually like the hard money lender for that. And this is why having a good relationship with a guy like you, because then I can go, hey, I got one, Johnny. Can you take a look at it and give me a term sheet? You underwrite it, send it back to me. And I see terms that I don't like, that I feel uncomfortable with, or I'm like, oh man, why am I not getting this much? That's an indicator to me. Like, man, did I underwrite this? I probably am calling you and going, hey, let's walk through these numbers. And then you're like, hey, I got the ARV here and you got it here. I was like, oh man, did I make a mistake? And usually the investor is being a little ambitious on the after repair value, or a little, maybe they're assuming less on the rehab than they probably should. So I think it's a good partnership for an investor that's working with a hard money lender.
I'm glad you used that word partnership, because I think before sending numbers over to anybody, it's important to talk through the deal as partners. So if Adam sends me something and Adam says, hey man, this thing's worth $330 all day long, and I go online and I'm on MLS or I'm on Redfin or whatever, and I'm looking in this radius of where the properties are that are close to the subject, and the best thing I'm seeing is 265. I mean, the first thing I'm going to do is call Adam back and go, man, I'm struggling to find this 330. Like, what are you seeing that I'm not? And maybe he left something out. Maybe he said, hey, listen, I forgot to tell you, I'm actually adding 400 square feet. It totally changes everything. So, sometimes there's a logical explanation, and sometimes people have diluted ideas about what things are worth, and having a second set of eyes, I think, is crucial. And, we're always here to gut check and look at things with people.
Yep. And I'm going to touch on one more point, Johnny, that I think is important for investors who are building a business around this. And a hard money lender becomes really critical to scale. Why? Because they have the funds that you'll need to do multiple deals. Even if you have cash, you can only spend so much, right? Like if you think about the velocity you gain in partnering with somebody like Johnny, let's say I have 200 grand, 300 grand in my own cash, and I do a deal.
Right.
And I go, okay, that went really well. I feel good about my systems. Let me do two at once. Well, now I'm looking at two purchase prices of 150K. That's all my money. I have no rehab money. I can't float two at once, right, even if I made a good chunk on the first one. So now I go to Johnny and I factor in his cost to use his money, and I make my purchase price, like I'm buying your costs. Like the seller is really paying for the hard money, not me, because I'm negotiating the deal at a good price that accounts for what I'm paying to use the money, right? That's the really important distinction. So now Johnny comes in and gives me 90% of two deals, and I just use my money for the overage. Now I can do two at once. And now two deals make me 50K. So now I just made 100K instead of 50K at once. Okay. Get my systems dialed in, get another crew to rehab, like feeling really good. Now I'm ready to do 3 or 4 deals at a time, go out and acquire 3 or 4 deals. Now Johnny can help me again with purchase prices and even rehab if I want with rehab. And now I can do 4, 5, 6 deals at a time. And I can gain scale and velocity on my money by partnering with somebody like Johnny. So that's the superpower there. All right. I want to go back to the beginning, Johnny. What's really cool about you and why you've been so successful, I can already see it, is like you worked in a service industry that was all customer service based. You were working at a nightclub doing drinks, like bartending, that kind of thing. And that's very relationship based, right? Like you're in that position, you're getting tips is where you're making your money, and you're getting tips by the experience you create. When you can bring that to this kind of more technical industry, you're going to be good at something you probably didn't even know you're good at, which is relationships and sales. Yeah. People want to work with you because you're a good dude. You make the process easy. You're easy to talk to. Like you have people's best interest in mind and you're making sure their experience is good. Do you feel like that helped you having that experience before coming into this industry?
Yeah, definitely. I mean, I said in the beginning, like people like to feel good and they want to have a good experience. And if you know how to deliver that, and you have your processes down, then should be able to. And, I think that's definitely been one of my keys to success.
Yeah, I think that's so cool. I think that's awesome, actually. All right. So talk to me about Renovo and the products you guys have. Like what kind of investors work with you? What are you guys best known for? What, why do you guys do a lot of business? Like why do so many people work with you guys as a hard money lender?
Yeah. First of all, thanks for saying that. We offer 3 things to keep it really simple: rehab loans, rental loans, new construction. Rehab and rental is 1 to 100 units. So you can do a duplex in St. Pete, a 40-unit building in Tampa, right? Like all of those things are within our product suite. Now, the leverage criteria might be slightly different. It's a little bit more money down once you go over 5 units, but the core concept is exactly the same. You're putting money down. We're holding back rehab funds, limited by a finished value, the ARV, and we're giving you a 12, 18, in some cases, 24-month term to complete the project. We also offer new construction financing. So that is, we're helping you buy the land, or you have the land and you have permits. That in many cases is the equity contribution. And then we're holding back the construction dollars as you complete the project. Those are the 3 things we do.
Yeah. And so a lot of hard money lenders are mostly just uber focused on that residential 1 to 4 unit fix and flip.
Yep.
I think you guys have a massive value add in that you do a lot of commercial stuff too. So commercial's basically anything over 5 units, and you guys can lend on that. So you do a lot of what we call in the commercial space, like bridge loans. Like, hey, I got to buy an asset and reposition it and then refinance it. It's basically a commercial burr.
Right.
You're lending on the front end of a burr of an apartment building or something like that. And then what's beautiful is if you look at the market today, is you guys are ahead of the curve, because a lot of people in 22, when I say people, like if you look at where the institutional money went in middle of 22, it was already leaning into build to rent models. They were already going into new builds. So you had all these big hedge funds who were buying up all the residential assets in 2020, 2021, and then midway through 2022, like you're talking Blackstone, BlackRock, like the big hedge funds, the big $1 billion money.
Totally.
And then all of a sudden they stopped doing that, like almost cold stopped doing that. And you saw their shift go into new build residential. And then I started to see a lot of investors, like normal fix and flip guys and gals, start to move to doing new builds. Why? Well, the debt market changed on the conventional side. And if you go out today to buy a new house, you go to a builder and buy a brand new house, you can get a better interest rate compared to if I go buy Johnny's fix and flip. I'm getting a 6-7% conventional loan as opposed to this builder who's offering me 4.99. And then you saw the new builds, new construction start to kind of skyrocket in that sense. People were favoring buying a brand new house over an older house. So
Right.
you guys are ahead of the game there. If you're somebody who's like, I'm going to do new builds, but I don't know like how to get the funds, like you got to talk to Johnny about this, because that product is super, super helpful for people who want to get, either change from flipping to new builds or are in the new construction game already. Like it's at least worth having a conversation. I know you and I've had that conversation. So it's a great product. I think you guys would be well served talking to Johnny. And by the way, his handle on Instagram is Hard Money Johnny. If you guys want to get in touch with him or find him on the internet, he's all about the hard money. So, Johnny, man, I'm grateful that you spent some time with me today. What would you leave the listeners with? What's your one piece of advice you'd leave the listeners with?
One piece of advice is to choose your deals carefully.
Choose your deals carefully.
Yeah, there's a lot of lenders out there that are in the business of making loans. I'm in the business of helping you build your business. You can't build your business if you're buying bad deals and you're losing money. So choose wisely, underwrite carefully, and give me a call if you're in the Tampa area and you need some help.
And how can people get a hold of you?
You can send me a message on Instagram, or you can just call me directly. I will give you my number to put in here, and we can talk through and see if maybe we're fit to help you.
Love it, man. Love it. Thanks so much for coming on the Florida Real Estate and Entrepreneur Podcast. I appreciate your time, brother.
Cool. Thanks so much for having me on. Super fun.